Hey guys, this is Tim Melvin of the Tim Melvin Deep Value Report and Banking on Profit Service, coming to you from down here on a really nice 80-degree day in Central Florida. We're starting to work our way back to the normal weather, really starting to enjoy it down here again. Had a big weekend this last weekend, went to the Daytona 500, saw the closest finish in the history of the race. If you're a sports fan and you've never done it, that should be on your bucket list of trips. It's a fantastic experience. Got really lucky with parking. We were just poof, poof, in and out of town, no problems. So just a great weekend altogether. Had a great dinner at Vines here in Orlando. If you ever get a chance to come to town, do not miss the opportunity to dine at Vines. It really reminds me of a 1960s area jazz supper club in maybe Midtown or the Upper East Side of Manhattan. Keep looking at the bar, expecting to see the Rat Pack over there. Fantastic experience. So if you get down here, please check it out. It's a great restaurant. Anyway, this is a big week for those of us that use the private equity mindset. Couple big things happening. First, in Berlin, they're having the Super Return Conference, and that's where the private equity and venture capital world gets together and talk about what's going on in the world. And some of the takeaways that we've gotten in the first day today is that markets are really losing faith in quantitative easing. Particularly the private equity guys are saying, look, it's been pretty good to us because it's pumped up asset values. In fact, over the last 3 years, we've been able to sell an absolute ton of stuff at unreasonable prices, and that's what we like to do. But it's not really doing much for the global economy. A couple of the comments, it's a much less attractive sales environment. The last 3 years have been fantastic time for private equity buyers to become sellers. Leon Black's famous comment in 2013, where he was selling everything that wasn't absolutely nailed down. And in fact, they did that. It was a good period for us as sellers too, as value investors. Although the newsletter started in 2014, we still own most of the stocks we bought in the very first edition. Some of the stuff that we bought in 2008, 2009, when things were just falling apart all around us, we sold at incredibly attractive prices. And I'm going to say particularly 2013 and 2014, when we started really building the cash levels up. Quantitative easing did a lot for equity markets and asset prices. It's not really doing much around the world for the global economy. Now, I'm not one of those doom and gloomers. I'm not going to sit here and tell you that the world's going to fall apart, but we are very much mired in a little bit better than it was, but not really great economy. We're the best here in the U.S. It's actually a little worse than that in Europe and parts of Asia. China is still growing, but it's growing at a much slower rate. I did talk to a guy the other night who does a lot of work in China, and he says he's not quite so sure that they're actually growing at anything close to the published 6 and 7% forecast. So we'll see how all that plays out. We're value types. We're going to keep our heads down. Think long term, much like the private equity guys. One of the panelists said that this might be a really good time to put your buyer hat on. Forget about the selling. That's over. That window's closed. The opportunity is gone. Now we're getting some turbulent markets. It's time to maybe thinking about being a buyer as time goes forward and market volatility increases over the rest of 2016. They talked about financing. They said that banks have really pulled back from this financing deals in 2000. Starting after the credit crisis, it's really peaking now. Capital levels are very high in the banks, but they've really de-risked their balance sheet. They're not making takeover loans and buyout loans anymore. That's kind of fallen to the middle market lenders and the private equity funds themselves. And a big participant, and I think eventually, although they've been rocked here over the last 6 months or so, I think that the financing of buyouts and takeovers, particularly in the middle market, is going to fall more and more to the business development companies. And that's going to ultimately, I think, be really good news for us, especially in our income portfolios where we have some of the better ones like the Gladstones and the Apollo investments that we like a lot, have very high yields and are getting access to some very good deal flow at this particular point in time. The other thing, we'll have more as we go on the Super Returns Conference. They're going to have a second day of that conference. There's all kinds of great speakers coming up. So we'll be talking and writing about that more as the week does go on. The other big news is Bain & Company. Now, not to be confused with Bain, the actual private equity firm. This is Bain, the consulting and research firm, Bain & Company. They released their private equity 2016 report, and they talked a lot about investing in a slow economy. They do feel like the economy is going to stay slow, maybe even get a little slower than it is now. Don't really want to see that, but that's kind of what they think is happening. And what the teams they really touched on are looking for companies that can accelerate growth. That's going to be a tough spot in the current economy. I think you have to look, maybe at areas like cybersecurity, some of the technology areas. And the problem there is, of course, it's very hard to get anything close to attractive pricing at this moment in time. I'll touch on some of that here in a minute. Still very high cash levels across the industry. Industry's got about $5 trillion in assets and 1.3 trillion of dry powder. So you've got somewhere right around a 20% cash level at the average private equity fund. Historically, that's extraordinarily high. These guys like to get their cash to work in opportunities that are going to provide high returns. Again, making it very interesting that 3 of the 4 largest private equity firms that are public actually decided to use their cash to buy back stock in the open market, as we talked about last week. Let's see. The firm also talked about to really prosper in the current environment, you have to take advantage of your strengths. Now, for us as individual investors, we have some strengths and some huge advantages over larger funds and our other competitors in the market. The 2 biggest of those are size and time. We can buy much smaller companies than the average mutual fund or institutional investor. For instance, in the community bank space, which is obviously my favorite space on the planet, we have a huge advantage. We can buy these little banks with 100, 150 million of assets and 10 and 15 and $20 million market caps. We can take a week to build a position and a week to sell a position. Time is on our side. If we like a company, we're not going to have to file a quarterly report with anybody but our spouse, possibly, and have to explain why we own this company that's not doing particularly well at this moment in time. And we're not that concerned because we're really looking 5, 6, 7 years down the road, and we're happy owners of the stock. Larger investors do have that disadvantage. They basically have to almost continually explain and defend their stock positions, and they're too big to buy the smaller companies. And that's where I think the bargains are right now. Again, look at the performance of the S&P 500, down a few percentage points this year. Compare that to the Russell 2000 with all the small companies. That's down about 25% over the last year. The bargains are in the smaller companies. That plays to our strength as individual investors. The other advantage being time. Of course, we touched on that a little bit here in the size component of this. We hold a stock as long as we want to. We don't have to defend it. We don't have to explain it. As long as we're comfortable owning it, we can, in fact, just own it. So time definitely works on our side. We don't have to turn over our portfolio 100, 150% a year to make some outside investors happy with what we're doing. They also talked about mobilizing around themes and concentrating on key macro sectors. Now, macro is not my thing, but when you look at what we're actually doing in practice, it's clear that we do have some themes to our work. Biggest one being, of course, community bank consolidation. It's been a big thing for us for years. It's going to continue to be a big thing for us for many years to come. We're sitting around 6,000 banks. Talked to a hedge fund manager at Rhino Capital earlier this year. He thinks late last year. He thinks we're going to get down to around 1,000 banks. That's a big drop from here, guys, and we're going to get there by M&A activity, not by bank failures. This is a long-term trend. I call it the trade of the decade. I should probably be calling it the trade of the next few decades, because I think that's how long this powerful trend and profitable opportunity for us as outside investors continues. Another trend, of course, is the single-family REITs. These things were all formed in 2009, 2010. They bought a bunch of houses. The houses have gone up. The REITs have not. There's got to be a catch-up there. They've had to deal with operational inefficiencies, and it's different to maintain and take care of and lease a portfolio of homes scattered all over town, all over the state, than one apartment building centrally located. Everything's right there. It's taken them a little while to figure that out. They have figured it out. We've seen our first big merger in the space. We're going to, in my opinion, see several more as time goes by. There's also the disconnect between public market values of real estate and private markets. The REIT, and particularly those, by the way, outside the indexes and the ETFs, the lesser known smaller REITs, the price of the property in the portfolio is trading at a huge discount to what you could sell those properties for on the open market right now. That's exploitable by us as individual investors. So we have some portfolios in REITs that we think are world-class properties run by very smart people that are going to do very well long term. We have a bunch of those in the portfolio because we're pretty sure they're going to work out extraordinarily well for us. Anytime I can buy assets for 70, 80, and in one case that I'm thinking of about 60% of the value of the underlying properties, I tend to think that's going to work out real well for me over time, especially when you have very smart management, and we do in all of the situations that we own at this point in time. There is some activist involvement in the sector too, and some of our companies actually have activists going, hey, we like you, you're smart, but you're trading at a big discount. Tell me what you're going to do to make the discount go away. As we know, that tends to work out very well for us as shareholders over time. They eliminate that discount, we make money. So we kind of like the real estate theme in here in selected situations. And private equity itself, in the last month or so, developed into its own theme in its own right as these stocks got hammered. The big sales opportunity has in fact gone away. They are not liquefying and liquidating prior deals and collecting huge fees, so the earnings and distributable cash flows are very high. But they are going to be able to put cash to work at favorable prices in certain sectors of the economy. Emerging markets and energy are two that were mentioned at Super Return in Berlin this week, and those could have huge payoffs going down the road. You've got 3 CEOs at KKR, Apollo, and Carlyle that decided one of the best places to do with things to do with their cash was actually buy back their own shares in the open market. All 3 of those stocks, by the way, have had a huge pop in the last week. I'd like to take credit for it, because I mentioned it on the video, but yeah, I don't think I have that much influence in the market. I just think some other folks have at least as good a pencil as I do and notice the bargain and the very positive comments on the stock price by the CEOs of these companies. So give them a little breather, let them pull back a little bit before you buy them. But 5 to 7 years from now, private equity time frame, I think that private equity firms are going to make you a ton of money if you're a long-term patient investor and you let Mr. Market work for you and buy them on down days, not up days. Don't chase them higher. Buy them when they go lower. So anyway, can't take credit for the bounce, but that I don't usually get these 10 to 20% 1 and 2 week bounces in my stocks, so it certainly didn't hurt my feelings, and I enjoyed it. Now, the other big news today is the FDIC quarterly banking profile was out. We ignore most of it. Look at the headline, go right to the community bank section because that's where our focus is. 57% of community banks in the fourth quarter increased their earnings on a year-over-year basis. Just 9.6% of all community banks with assets under $10 billion were unprofitable for the fourth quarter of 2016. 77 fewer banks, folks, year over year, fourth quarter to fourth quarter. Only 2 of those, okay, just 2 of those were bank failures. So 75 takeovers in the fourth quarter of 2015. 70% of community banks increased loan balances. Non-current loans fell again. It's the lowest rate since 2007. That's actually big news because non-current loans among all banks actually rose a little bit in the quarter. Now, there is one little bothersome aspect in the report. Second quarter in a row, commercial and industrial non-current loans rose a little bit, 1.1%. We're watching that like a hawk, okay? Rising non-current balance in the C&I portfolio is a little bit of a red flag. Credit's been as good as it could possibly be, so it has to get worse at some point. Overall, it's not. The C&I is just a little bit. We're watching it very closely. Should that start to accelerate in some of our portfolio banks, that could lead to us rethinking our ownership of that particular bank. One thing we never want to get caught in community banks is a credit problem. We never have. Hopefully, we never will, and we'll see how it plays out, but we're watching this very closely. Overall, very rosy picture. Still absolutely the best place to be. Most of the institutions are profitable. Over half of them have increased their profits over the last year. The M&A wave is still very much in place. It's going to accelerate as we go forward. Most of the people I talk to think that we're going to see more deals than we did last year. When we saw around 260 deals, I think the final number was. I talked to one guy and have reported on it, thinks we're going to see 400 deals this year. I think he's high, but I hope he's right because that would just be incredible for us. We'll see how that plays out. If community bank stocks are not a significant part of your portfolio, you are making a mistake. That's all I've said every week. Going to keep saying it every week because if you can buy these, and I told somebody on Twitter this today. By the way, if you're not following me on Twitter, it's just at Tim Melvin, and we do a lot of news articles and discussions about banks and value stocks. It's worth the follow if you're not already following me. I like to think I'm a little snarky and sarcastic, but you'll get used to that. So, but anyway, I told him on Twitter today that if you can find a bank trading at 85% of tangible book value that has a sound loan portfolio, a strong balance sheet, and there's an activist involved in the stock, it's the closest thing to a layup you're going to see in your investing career. Found that to be true for the last 25 years. I think it'll stay true for the next 25 years, if not longer. So if you don't own them, you should. If you're worried about the illiquidity and the fact that they're small, well, you shouldn't worry about that stuff. That's actually works in your favor, not against you. If you're not in them, get involved. It'll be a special offer in the comment section, so you can get involved at a little bit of a bargain price with the Banking on Profits portfolio, and I hope you take advantage of it. So, coming up, great week, spring training going on, full workouts today down there in Sarasota for the Orioles. First video will be not Tuesday next week, guys. Probably I'll either get it done Monday or we'll do it Wednesday morning, because Tuesday afternoon I will be sitting at ESPN Wide World of Sports watching the Orioles hopefully beat up all over the Atlanta Braves in the first spring training game of the year. It's Florida's version of opening day, and there's exactly zero chance that it will snow, unlike many of the opening days I went to back in Baltimore years ago. I can actually remember an opening day, Jim Palmer pitching in a snowstorm many years ago. Not a chance of that, either Palmer pitching or a snowstorm, but we're going to have a really good time anyway. Excited to see baseball season back once again. The spring book release catalog is coming up, and the first week, next week, we've got first half of the month, we've got Clive Cussler has a new book out. Really excited. On March 15th, Randy Wayne White's new Doug Ford book comes out. We always look forward to those. Jeffrey Deaver's got one coming out. Tobias Carlisle has a new value investing book that will be out a little later in the spring. Got that on pre-order already. Tobias has done some fantastic books, quantitative value, deep value. He's become a pretty good friend over the time. We talked often, one of the sharpest value investors on the planet. So make sure that you get that on your list. Also just received, and we're going to dive into starting tonight, Dear Chairman, which is a book of letters from activist investments to boards and CEOs, and of course the chairman of the boards of target companies. I absolutely cannot wait to read this. It's going to be fun. It's going to be educational. Should be on your reading list. I've heard great things about it. Tobias did one of the reviews and said that pre-publication reviews said it was a fantastic book, fun to read. So order that one today, whether you get it at the bookstore or Amazon. Dear Chairman, should be a great read. Greatly increase your knowledge of value and activist investing. Anyway, guys, that's all from down here in Central Florida today. Like I said, it's very nice today. Getting ready to rain. Going to bring us a little cold front. We're going to dip all the way down into the 70s. Might have to get a long sleeve shirt out or something. But anyway, this is Tim Melvin. We will talk to you next week, and I hope you guys have a fantastic week. Thanks very much.